Good afternoon, Scott Redler, T3 Live. Welcome to today's edition of StockTwits Q&A with Red Dog. And look who I have to my left. I have Taylor.
Hey.
How's it going, Taylor?
Good, how are you?
Doing good. You've seen Taylor. Taylor does a lot of work with the morning call. She's a great trader on my desk, so she's very versatile. She knows the media, she knows the stock, she's in the trenches. So she's going to be a great partner to answer your questions, and I might even have to answer your questions, ask the questions, but I might make her answer a few.
Oh, good Lord.
Every now and then.
Every now and then, okay.
So with the way the market's moving around, I think it's time to just, delve right in and go with the first question.
All right, our first question is from Stock Vicar. Do you use the SPY for market direction? Can you explain how you use the SPY? I noticed you shorted a lot. Can you explain why you do this?
Well, there are a few questions within that question.
There were.
Okay, within the last 2 weeks, I've been short the spiders as a hedge. I haven't been using it as directional. So I've been trying to be long 4 or 5 situations through, 4 or 5 different stocks, or sometimes 7 or 8. I think today I was up to 7 or 8. And what I've done so I could sleep at night is I've had the spiders on as a hedge, because we talk about managing positions. We've talked about having the stocks you like, the leading stocks, so this way you could stay with them as the market's been trending, because we have been trending, believe it or not. Everyone out there is all bearish and upset and miserable, but meanwhile, since the June 4th lows, we've had quite a move, and there's been a lot of participation amongst a lot of sectors. So if you're on the virtual trade floor, I know I try and tweet as much as I can to let people know what we're doing. Sometimes you get half the story, 3/4 of the story, the whole story. Depends on whether or not I have enough thumbs. But basically, I try and, lately, depending on the market, be long multiple positions and then have a spider hedge on. So if the futures open up down, I could then make some money in my short spiders, cover them into support, because that's been working, and then look at my position, see what's showing relative strength, and add to them. So I think the other question, on that was direction, right? Do I look to what was it?
Do you use the SPY for market direction?
Well, I like to use the S&P, as a big broad market gauge, because obviously there's 500 stocks, and that typically is what the real money follows. Like in the media, they'll talk about the Dow Jones, they'll talk about the Dow, but I think that's not the great representation of the market. I think it's the S&P, and I know there are traders that trade the futures. I trade the spiders, okay? And I think a lot of people at home trade the spiders, so I try and talk about something relative. And if you look at the chart of the spiders, you will see, or first go with the SPX, that I just want to show you guys a trend here, okay? There were 2 basic patterns that I just want to show you that happened this year, or actually 3, okay, real quickly, little technical analysis 101. First pattern we had here was this wedge. Remember this wedge pattern? Remember I was on CNBC with Brian Sullivan. VIX was crashing, actually. Everyone said it was broken. I was like, maybe it's leading to something else. And right here, the wedge broke to the upside. And for the first quarter, you were able to be long, which if you're on the virtual trading floor, 8, 12, 15 positions with the spider hedge as we followed the 8-day, a few times tested the 21-day, until finally the first quarter ended, and then we saw this distribution pattern put itself into, intact. All right, so at that particular point, people say technicians were getting bullish. I say, I said we talked about 10 different times this head and shoulders pattern, left shoulder, head, right shoulder, right here. This is when IBD went back into market correction, and this is when he sold, 1360. You remember this? Measured move from the top of about 1422 to the neckline, 1360. That gave you a move down to pretty much where we stopped. So this was a good spot to, maybe book your profits if you were short, look to see for some type of reversal pattern, and then here you go. Right here, you had your red dog reversal. Okay, you had a quick move off that, so that showed you that there was pent-up movement and negated this throwdown past the measured move. And then really, you had this commitment right here. This was the commitment where if you missed this move off the lows, you said, you know what, I sold 1360. I feel like I could be a buyer around 1310, or maybe you sold 1380. It all depends where you were. Remember we talked about the inverted head and shoulders pattern, and this being the neckline right here, that we broke above and then retested, and lo and behold, here we are following this trend all the way to the upside. We had a little bit of a fake out right here, and you know what? I'm not a permeable. I got short right there also with everybody else. Okay, so hear me out. We are technical traders that specialize in intermediate trends, finding the fastest moving stocks, and we try and take what we can out of the market. And in 2007, when the market had its huge decline, you probably saw me on TV, every other week, and we were short, and our firm actually had one of its best years because we love being short when the markets are short because stocks go down a hell of a lot quicker than they go up. So with that said, just because we're riding a trend right now doesn't make us permabulls. We stay with the trend and we try and look at the price action, not using opinions. So if you go back to the chart, you'll see that we followed this all the way up, and then lo and behold, look where we are, or look what we've been talking about right here. Okay, here is this upper range, and you probably heard me talk about it many times. That the bears were saying we're stalling, the bulls were saying digestion, and I was in that digestion camp because you saw a lot of participation from the leaders. You saw, CF Monsanto in the ags as leaders. You saw XOM and CVX, in the oil space. You saw high beta, Apple, Google, Amazon going nuts. You saw participation in other groups. So this was telling me that this was going to resolve to the upside. So here we are today. We broke above 1410. We closed around 1415. That takes you all the way back to right around here, which was this high, and we're a stone throw away from the highs of the year, which comes in at 1422. So overall, price action has been giving us clues to stay with this rally. Yes, there are times to be long, and there are times to be heavy, and there are times to have 1 foot in the door, 1 foot out the door. In this upper range, we've had probably 1 foot in, 1 foot out. And then today was a day that I think a lot of guys, including Sperling, was going to be coming on, added to positions, played for breakouts, made some cash flow, and then went back to what we were originally trading.
Okay.
And with that said,
we have another question on the SPY. It's from Chart Girl NYC. I saw you flipped with the SPY today around 141.40-ish from short to long. I thought the position was a hedge. What is your reasoning here?
Well, because we are active and professionals, we get to choose what we want to do intraday. So overnight, you have no control. Futures do what they want to do. So that's why I've been having the spiders on as a hedge. But I know that if I had no positions on whatsoever, and I was looking at this 7-day tight range where we were holding higher, where we were having a hard time getting over 140, that if I had no positions, I'd be buying the spiders right there for a directional move. So if you go to the chart of the spiders, let me show you why. Okay, let's take a closer look right here. So I was holding like 6 positions at that time, but I saw an opportunity to leverage and get in based on a price pattern for cash flow. And right here was this new ascending little channel or high level flag, and figured if people were rolling up shorts, which a lot of people have been rolling up shorts this entire way, or remember what I said right here, I was short, I covered right there. Okay, I said I'm wrong. We popped right back in this channel. Remember the channel? And I said I'm out of the way. I'm going to try and readjust. So P.S. This was your line in the sand. Okay, this was the high here of 141.38. So we went to that point and we stayed there. And I said, we get above this, we're going to be testing 141.66 to maybe even the high here of 142.22. That was 142.21. So if you look at the 5-minute chart, you go right here to the spiders. This is right there, okay? Here is the morning, okay, where there was a lot of indecision. Here was your first move, okay, to the upside. And then right here, I said, you know what? I think that we break above this point. If we get above 141.40 and stay, I can make some money long. So I went long the spiders, and here you go. Another move. If you're on the virtual trading floor, you saw it turn red to green, and people asked me about it. I said, I like it. Went all the way as high as this area. And then, we closed right around 141.99. So what I did on the close to maneuver my trading account as if it was a portfolio, I said, you know what? I'm not exactly sure compliant-wise. I think I have 6-7 positions. I'm going to go away from being just directional long like I was the majority of the day, put my spiders that I took intraday to make money long, go back to short as a hedge, because you know what? Something could come out overnight. The futures could be down. I want to have a hedge just so I could sleep a little bit better. So if we open down, I'll make some money on my spider hedge, and then I'll look at my positions. I'll see if they're showing relative strength, and I'll add on the dip. And then next time we rally up, I'll sell some of my positions. And then as we extend again, I'll short some spiders. And I'll keep doing that until this trend changes, and the trend has not changed.
All right. I have a similar question just in terms of options when trying to hedge. Toronto Shark, Red Dog, when you're using the SPY puts to hedge longs, do you close the hedge on a day like today? I bought IWM and the Qs instead of selling the puts.
All right, I'm not exactly sure what the question stated. If you want, read that one more time.
Okay,
There you go. There's a few questions within that question.
Okay. Red Dog, when you're using the SPY puts to hedge longs, do you close the hedge on a day like today? I bought the IWM and the Qs instead of selling my puts.
Okay, so it sounds as if, he had the puts on
Right.
in order to hedge whatever he was holding in his portfolio. So, day like today when we extended, he's saying, would you just get rid of your hedges? I wouldn't get rid of my hedges. If anything, you take it off at a price point. Like if you took off your hedge at 140, 140 and put it back on 142, you just saved yourself 60 cents from that hedge because intraday you saw the price pattern. So it sounds like what you did is you added longs by going long the IWM and the Qs, which is different. So if you are long the IWM and the Qs, it's probably good to have a little spider puts on as a hedge. I'd rather see you, not use puts as a hedge just because of the time value and whatnot and the decay. I'd like, same way I don't like really the VIX as a hedge. I'd rather see you have multiple positions and use the spiders as a short as a hedge or even the Qs. And just to talk about the Qs, I know, I've been talking about the Qs a lot lately, and this is what also, had me very bullish is, we broke above this area. This was, I think, almost a few weeks ago. This was back on August 3rd. Then you had your high-level consolidation. And look at this day. This day, the Qs went above 813, August 18th. The Qs are now above this flag. So that means the Qs started saying, you know what, I'm not waiting for the spiders. I'm not waiting for the transports. I'm not waiting for the IWM. I'm strong. And traders love to see the Qs lead the market. And look at this powerful day. So just to show you a little divergence here, on August 13th, we are now above this 5-6 day range. Go back to the spiders. Where were we on August 16th? We were right here. So August 13th, I'm sorry, still in that range. So spiders didn't have enough power to break above. The Qs were saying, you know what, I'm leading the way. I'm the general in the field. I'm not waiting. And then meanwhile, look at today, and we're right back at those highs. A lot to like here. And as far as the IWM, we talked yesterday that they were ready to break this downtrend in the morning call today. Everyone's always pointing out how this was a problem. The transports were a problem. P.S., it wasn't a problem for people looking to add to it through a price pivot point. And here's your price pivot point. Here you go. It might not be leading the way, but we're not in a phenomenal growth environment. We're not in a blazing economy. We're in a whatever, blasé economy that is, with the stock market acting well, whether it's because of the Fed, whether it's because of stimulus, because of central planning, who knows? The facts are the facts. We had a 7-day range. We broke above it. If you were long, you made money. Why it happened, we're not all smart enough to answer that question. So, if you think you are and you want to keep, making, what's the word? Excuses?
Yes.
Making excuses on why you're not involved because you think you're smart and you're hoping, oh, those guys who are long stocks, one day they're going to get theirs.
Right. Okay,
well, we'll see what happens.
Right. We have one more question in regards to the market. You were actually just kind of touching on this. What could, this is from Market Picker, what could be the driver fundamentally to the market being at highs, the Qs, the SPY, the diamonds all at highs, and IWM is breaking that wedge pattern?
Why does it have to be fundamentally?
This is just a question from Market Picker. I was wondering if maybe there's like a fundamental,
how about this?
Theory behind it that you might have.
I don't know exactly what the PE of the S&P 500 is, but I know a few months ago when I came out and I said I think the S&P is going to be at 1,700 by 2015, there was a calculation, which I don't have in front of me, showing me how the S&P 500 is trading at a discount, I think, to the last 60 years or something like that, that if we just traded back to the average, if the S&P traded back to the average PE that we've had, don't quote me because it was like a Bloomberg article, that we would be at 1,700, I think, right now. So anyway, fundamentally, we just went through earnings season, and some companies reported well, and there definitely was a lot of misses on the top line. Okay, but the more important thing was, how did the companies act? A lot of stocks that got battered and bruised had it priced in, so when they came out with a poor report, everyone's like, oh, it's a poor report, I'm going to short it, and it went up. How does that happen? Meanwhile, stock went from 60 down to 40. Maybe that 20 points to the downside is what was priced in. So you have to know where the stock was, where it's trading at earnings, and figure out if the report is priced in or if it was really a surprise.
Okay.
At this particular point, don't ask why or what's going to be the driver. Just evaluate the action. And you don't have to be all in. You don't have to be buying and chasing up here. There's been a time and a place for a lot of good solid entries. Now's the time to trade them and trail them, the way I would say. And stop looking for excuses not to be in the market. just come up with a plan and a process, and there's a lot of people making money on a lot of different time frames. There are a lot of stocks making all-time highs, mega cap stocks you could have held for years and been doing very well. So I don't believe Bill Gross. I said it a month ago on CNBC Asia that I don't think the equity market's dead. It's only dead if you try and throw darts at a wall and you think that the market's giving away free lunches.
All right, thanks, Scott. We're going to take a short break here, and we'll be back with Sperling.
Hello, everybody. My name is Pete Renzulli, Chief Marketing Officer of T3Live.com. Really excited about introducing you to and inviting you to the first T3 Live Active Trader Summit. There's going to be a ton of great content, but the number one reason you want to come is you want to be able to network and associate with other like-minded people who have a burning desire to learn how to be a trader. So I'm going to ask you to make a trade. Trade one Saturday for some of your time to come down and learn strategies, tactics, techniques, and put some faces to the people that you see in the virtual trading floor in T3 Live, and learn to take your trading bigger. Learn how to be a better trader than you are now. Learn the strategies. It's going to be a lot of fun. Go to T3Live.com and register. If you would like to join us at the post-event cocktail reception, you can also upgrade to either premium or VIP. That's up to you, but either way, please take advantage of the general admission. 2 free tickets. Come down and expect to have a great time.
Hey, we're back here with Mark, and we're going to have a great opportunity this afternoon to ask him some questions, so definitely write in.
Thank you, Taylor. So, what was the first question?
Okay, so let's see here.
She gave me a cheat.
I did.
The cheat
Okay.
sheet.
Turbo Gumbo, what is your read on LNG?
LNG, it's a natural gas play. I mean, it's energy play. It seems like it's hanging in there, bounced off its 200-day. Looks good. Looks good. Doesn't look like it's very exciting, but nice little tight base wedge pattern forming. Looks like against 1350, getting involved right around here. It looks like a move to 1650 is in the cards.
Okay, great. Our next question is about the banks, and it's from Chart Girl NYC. The banks didn't really rally with the market today. What do you think of this group?
They're basing. The longer they base, the better off you are. I'll just put J.P. Morgan up here, Goldman Sachs. I'll just briefly give the few. Citigroup even, Wells Fargo. Understand fundamentally, I'm not looking at it fundamentally. Everybody's like, banks are going to earn much less money as the years go on because of trading and how, all the laws have changed. Agreed. But the fact is, right now they're basing. They look okay. J.P. Morgan's staying above its 200-day moving average. I like that. So you got to get involved. You should probably be dipping your feet in some of the banks right now, but certainly not aggressive. It's more just the feeler. So when it actually does go, you really don't you don't miss it. So J.P. Morgan anywhere around here, 37, 36.50 I think is a safe level. You'll probably add above 37.50 to 38, and that will be the gap to about 40. Goldman Sachs, same type of trade, adding right around here to 100 area. And probably add above 105 for a move to 110. Wells Fargo, same type of play. So I like them. They're boring right now. They're basing. The longer the base, the next time they do actually make a move, whatever direction that is, more likely that move will stick.
Okay. Our next question is from Miss P. Zoom. What is your thought on Netflix with the steady increase over the 7 to 10 days? I know you were talking about this today.
Steady increase after a after a big downdraft. Netflix, to me, I think if it tries to get into that gap, it'll probably fail. So I would say maybe you got a chance to 68, which looks like one of the moving averages to me. But overall, I'm not that excited with it. And, again, I would be taking trades. You're always vulnerable to the short squeeze, that news comes out. So short, I wouldn't be short either, but at the same time, roughly around 70 would be the level I'd probably be looking to put a short on. So that means you have $5 more possibly on the long side. I don't think it's going to be very exciting right now, though. Okay.
So we're going to bounce around a bit here. We have Kenner0966. Spurls, what are your thoughts on gold and silver? Noticed AGQ and NGT and DGP all above the 50-day moving average.
Gold and silver. Gold's hovering right around the $1,600 level. To me, that is more bullish than bearish, but at the same time, if you're going to trade the GLDs, you just have to really, it's a swing. There has not been a day trade, that's really had follow through, and Scott knows that. Scott's has been trying to trade this thing, and it's been very frustrating. It really just, every other day, it's a reversion to the mean. So, in my opinion, it looks like it's going higher. There's some big boys long it, i.e. Paulson. It seems like it wants to go higher long term. Short term, a move probably above 158 will trigger that it can actually maybe move to 160 to 162 on the GLDs, which maybe triggers a move to 1700, 1750 on gold overall. Silver, same type of trade. It's not a day trade yet, but a move above 28, you'll probably get a move back to 30, which is probably a little healthier. And this has not been involved at all. So that might be a little bit, safer play, and you might actually get more bang for the buck. So keep them on the radar, certainly. Don't look at them for the day trade yet.
Our next question is from Jared Finchman.
Hello, Jared Finchman.
Hello. That's a difficult name. What is your opinion on the recent move in Phizo? Will it have with blah, 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 blah. Let's start over. What was your recent opinion on Phizo have continuation power?
Does it have continuation power? Well,
I cannot say that.
It's okay. Does it have continuation power? Well, we talked about it today. I've been talking about it probably for 2 days. I was looking for an entry. Those earnings were good. Those earnings are good, and the fact is it's heavily shorted. That's why it was obviously, gapped up above 26, went to 28, and even today, I would have liked to see 1 or 2 more days of digestion, but I was involved early in the morning. I got a little heavier around 26.50. I was talking about it on the chat, so if you're not listening to the chat, you probably missed it, which again, another reason to at least stay tuned. It looks good. I know there was rumors, they have to get bought out or taken out based on what they have. They're taking business away. I don't know about that, but right now it looks good to me. It looks like a quick move to 30 is happening. It's already started. So would I be chasing it right now? No. But at the same time, it looks like it can be. I've thought this for a little while, and I really have not gotten paid heavily on it. But I think it's a new breed of stock that could become a market leader as time goes on. We're not there yet, but short term, it looks like 30, 32 is in the cards.
Okay. Speaking of market leaders, we have a question from CPerkone. What are both Apple and Google headed for 750?
Yes and yes. Yes and yes. If the market continues to uptick at all, yes and yes. They're both going higher. Google has been boring for almost a year. I mean, let's call a spade a spade. It really has done nothing the last year and a half. Finally showed its strength after earnings. Buyers want in, and you can just tell there's buyers every dip. And even if we pull back, it's going to be a buying opportunity. So, in my opinion, this might even be, Apple's still Apple, so it's still the leader. But Google's going to keep a close race. So both of them look great to me. Apple, I think, makes a new high very shortly. Google's already there on a yearly basis. So they're going to go toe-to-toe for a little while, and I think over 700 is in the cards for both of them.
Okay. I think this is a pretty good question from Cowhand. Talk about how to identify and put together a handful of leading stocks to trade for cash flow, momentum, and to follow trend.
Well, if you're listening to whether it's Scott's, off the charts, whether it's my morning game plan, we talk about the leadership. We see where it's at. So, we do a lot of the heavy lifting for you, and it's your job to really sift through that and figure out where you want to be. Probably some of the ideas we talk about, there's a lot of them. So you really have to figure out and own your ideas once we talk about them. Just like I do every night. I go through my, 50 to 100 stocks, and I keep, sifting through it, figuring out which one I think is going to work today or which one I want to really get involved in over the next few days, next few weeks, whatever. But the key is, there's a lot that goes into what creates new leadership. We're going to help you out on that department. It's a lot of fundamental stuff, mainly a lot of technical stuff. But the key is when you start finding the leadership a la Apple, Google, some of the stuff we're talking about, EQIX, ALXN, AMZN, some of these stuff that, again, big boards, which I've been talking about, you look for key moving averages to get involved in if you miss it. So on the pullback, when they look the scariest and they're holding key moving averages, that's when you get involved. And you just trust that the technicals will make some sense.
Okay. Question from Market Picker. Sperls, what are your thoughts on Fossil for a move up to its 200-day MA? Would you keep a stop at the gap or the 8 EMA?
Probably keep a stop at the 8 EMA at this point in time. You know, you're still talking $5 from there. It's around 88 from what I'm looking at, and it looks like the 8 EMA is around 84 and change. So it's still a $5 move. What do I think you can get to? You know, again, you're looking at 92 as that beginning of that gap. If it gets in there, certainly get to 100 and regain some of its luster, like some of these other retailers, which I do like right now. There's a handful of retailers I do like. It looks good. Just make sure your risk versus reward makes sense. That's the key. You got to own. If you're going to own an idea, make sure your risk versus reward makes sense. Risking $4 to make 10, fine. I like that.
Okay. Our next question is about Facebook. Text. If Facebook is hanging in here with heavy volume, is it a buy?
Well, the question is it hanging in there with heavy volume?
You did say buy the dip.
Well, when? Today?
Just now. I'm just...
Oh, buy the dip on stuff that is actually leading and
right.
The moving average is on the right side. Facebook right now has made a lower low. Do I think it's a good do I think it's a good investment at some point in time? Maybe. It's now, you know, from what I hear, $18 is a $50 billion, you know, market cap, where obviously it IPO'd at $100 billion. Right now, it's going to hover between 19 and 22. That seems like the level it wants to hover around. Maybe it gets to 18. If it drops any further, you know, you're obviously going to get some quick money. It's going to be tradable. I quite frankly have not traded it. I wouldn't waste a whole lot of time from a trading perspective to really look at it every day. I don't think it's necessary. I think over 22, 23, it gets a little interesting. Maybe for a move back to, you know, 25, 26 if it gets back to that gap. But right now, why waste your time? Waste time and energy right now. Not necessary. If you're looking for an investment, it's a whole different ballgame.
Okay. Thanks for clarifying.
No problem.
Question from S. Davis Z1. Thoughts on McDonald's on the pullback?
I think I said this last week or the week after. Technically, it doesn't seem like it's quite there yet, but it's McDonald's. McDonald's at some point, you know, always shows its face. I like buying, you know, best-in-breed brands, but I like to see moving averages and technicals sort of line up a little bit. So I'm not dipping. I know I tried, I think probably 2 weeks ago to take a trade in it. Right here at this level, yeah, do I think it should hold 85? Only issue is we're now on the other side of the 8-day moving average and the other side of the 21-day moving average. And the 200-day is 76.49. So you might need a lot more time before McDonald's is going to show, you know, some real strength. But at the same time, it should always be on the radar. Something you look at, you know, on a weekly basis certainly, and see if there's any sort of technical setup that makes sense. Right now, we're not there.
Okay. Sperling, thank you so much for joining us this afternoon. It was such a treat.
Thank you, Taylor.
Yeah, we're going to go to commercial and we'll be right back.
See you guys.
Hi, I'm Sean Hendelman, CEO of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
Hello, everybody. My name is Pete Renzulli, Chief Marketing Officer of T3Live.com. Really excited about introducing you to and inviting you to the first T3 Live Active Trader Summit. There's going to be a ton of great content, but the number one reason you want to come is you want to be able to network and associate with other like-minded people who have a burning desire to learn how to be a trader. So I'm going to ask you to make a trade. Trade one Saturday for some of your time to come down and learn strategies, tactics, techniques, and put some faces to the people that you see in the virtual trading floor in T3 Live, and learn to take your trading bigger. Learn how to be a better trader than you are now. Learn the strategies. It's going to be a lot of fun. Go to T3Live.com and register. If you would like to join us at the post-event cocktail reception, you can also upgrade to either premium or VIP. That's up to you, but either way, please take advantage of the general admission. 2 free tickets. Come down and expect to have a great time.
Hi, we're back here with Scott now with a few more questions. All right, we're going to jump right in with Starbucks. Trader LT, Hi, Red Dog. Any thoughts on Starbucks at current levels? It's considered too late to get in?
Well, we were looking at Starbucks about a week and a half ago. I think I was on CNBC Asia, and I was like, I think it's getting ready for some type of bounce. And on the price point sheet, we talked about 44.20. I looked at it also in the Twitter sphere, talked about it. And finally, it gave you a move off the lows. So at this particular point, it's a little bit more difficult. If you look at the chart here of Starbucks, you'll see, you had the earnings. Remember that earnings was a shortfall, boom. Then it wedged or, gave a small little pause before continuing to the downside. So at this point, I'm like, let's be on alert for some kind of bounce play. First of all, Starbucks started being faulty well before then. We talked about this wide range, 2-range bar where all of a sudden, you had a breakout failure. And I always say how breakout failures, give you a little bit of trouble. So anyway, it broke out. Well, let's not even get that far. We don't have enough time to go into it. So the bottom line is, here you go. This 44.20 was that buy price right there. 44.20 had a nice wide range bar. If you missed that, because this was very hard to catch, because I remember I was trying to play it in here and it wasn't that clear cut. You wanted to say, okay, here you go. I want to see commitment to this igniting bar because this ignited a new trend. There you go. You held the top, not even the top third, top 20% of this move. So you could be in tier 1. Then it started to get back, in vogue once it crossed above this level here of 45.66. You had another entry. And now, we're in this gap. It's still holding higher, but this was like your easy bounce move. I like the fact that it took back the 8 to 21. You have the 50 up, the 50 up there. I guess it could, it can continue to go higher before it gets, massive resistance, which will probably be a little bit closer to 50. Again, easy part of the bounce is in on a broken stock, but again, it's Starbucks. I think this is where, you're going to get some massive, massive resistance. Look at the support here. Typically, support becomes resistance, so you have some room from about, 48 and change up to 50, but just make sure you're in a little less because I don't see a clear-cut setup. This was setup number 1. This was setup number 2. Now just trade them and trail them.
All right, great. So we have a question from Chart Girl NYC. Nice call on LVS. What makes you stick with this laggard stock?
First of all, weren't you just in Vegas, Taylor?
I could have been in Vegas.
Yeah, where'd you stay? What were the hot hotels over there going on?
I was at the Cosmopolitan. It was very, very nice.
Was it crowded in Vegas?
It was really, really crowded in Vegas.
All right, so maybe that's why I'm sticking with the hotel names, because if Taylor says it's going on in Vegas, it's going on in Vegas.
There you go.
Anyway, if you remember in the beginning of the year, we were all over the casinos, and then they topped out. There was a lot of good trading going on in the first quarter, and then it just became faulty. Every uptick was sold until finally we had capitulation. I tweeted about it. We talked about it. It was off the charts. It was on the price point sheet. I said, look at this date. You have volume. You have, it just looks like it's it. It was on earnings day. Finally, the earnings were bad, but just the same way they sold the good earnings at the top, figured it was capitulation at the bottom. If you look at the chart of LVS, you will see, this is exactly what I was talking about right here on this day. I like to put the volume in because the volume is what we went over that day. Unbelievable volume. Look at the size of the volume here on this low. Nice tail right there. So it opened down, closed a little bit better. The swing trade was buying it on the close, saying I'm going to give it to the low here of 34.72. That was your swing trade. Another additional trade is when you see this small little downtrend. First of all, you saw some commitment, right? It traded off the lows, and then it held, higher. So it didn't just come back down, didn't retest this area. It stayed up there, showing some move off this lower level. So in order to stay with laggards, you need to see commitment to the laggard range. Then right here, if you miss this move, okay, this was your entry. We talked about it again on Twitter all around. This entry was like 38.30, and you had to move up to, prior resistance right here, going across. And then what happened? You had a nice flag type pattern. In this flag, there was news about money laundering, this, that, boom, bam. All I know is that you go from the capitulation low to the high. You want to measure the commitment here, like watch this, just to give you a quick little, even show you on the Fibonacci retracements. Strong situations hold the top third of the range. So here was your move, the first one off the bottom. From here to there, what did it come in and test? It tested, what is this, like the 50%, not even the 50% range. This was like 38.2, so it showed some commitment to this move off the lows. And then you had a nice tight pattern. Last night off the charts, we listed it. Today in the morning calls, a quick hit. I said above, what is this, 39.65, that's your entry, and I went long it on the virtual trading floor. That's a luxury of being on the virtual floor. You see when it turns green. You don't have to wait to see the tweet about it. That's why the product exists. And PS, nice strong close, above this area. Question is, will it continue? How far could it go? At this point, you really never know, but it did close strong. This is like almost day 2. I like to sell into day 3. I think that at some point it's going to, test this 200-day moving average, which comes all the way up here around 45. So, if you're involved in it, I wouldn't be, your time for tier 2 is right around here. On the close, back to tier 1, and then figure out and measure the commitment. Last time it broke out, it gave you 3 days. This is really like day 1.5.
Okay. We have a question about Amazon, and I know that this was on Scott's radar and the teams today. So, stock alert. Lots of S's there. Thoughts on Amazon after action the last 3 days, and EQIX, which Sperls has been suggesting.
Amazon was very tricky today.
It was.
Which goes to show you that if you try and put on too much size in the first 15 minutes of the day, you better be able to handle it. Because, we entered today saying, Amazon had a really nice day yesterday. That was when I went long Amazon. I haven't been long Amazon really as like a swing trade in the past few weeks. There was a trade through earnings through 228, 230. It's been on our price point sheet and off the charts. And typically Amazon is just not one of the ones that I trade very well. I like to trade Apple, I like to trade Google, even some of the other stocks. Amazon, it gets me sometimes, so it needs to be perfect. So yesterday was one of those perfect entries. We tweeted about it, we talked about it. I think the entry was like 235, 236. The swing trade or the add-on trade was above 240. You look at the chart. This is when it woke up on earnings. This was the gap up from the prior quarter. It came in, held. Never filled the entire gap. Started to consolidate here. Here was the last earnings. Everyone said it wasn't great. It didn't look great to me either. But who am I to argue with the chart pattern? That's why I'm a technician and I try not to be an analyst. But anyway, here is when it triggered above this, came back, tested, and then yesterday, look at this nice green day. Nice green day in the upper end of the range, got me long, and then the continuation was above yesterday's high at 238.14. And then another price point was above right here of 240.74. Today it hit a high of about 242.82. If you look here overall at the macro chart, it looks really good. The highs of the the high to contend with is 246. I as an intermediate trend trader, okay, which is what I am. I'm not a macro investor. I am a macro investor in a 401k every single month, long term. But as my profession, I'm an intermediate trader. I try and hold positions that are working. And sometimes I take 2-day trades, sometimes I hold longer. And since I'm not that great with Amazon, and plus I added a little bit too early today, and then my P&L started getting pretty red, right, Taylor? Were you in that Amazon trade in the morning?
I was.
And it was hard because we in the first 10 minutes we bought the highs. It went up 30 cents and then it came back into 236. And all of a sudden everyone's like, oh my goodness, we just chased it. And then if you waited the first 30 minutes when it started to really set up, you wouldn't have been involved in the craziness of the first 10 minutes. So anyway, it started to get better and get stronger, and it traded through the pivots. That's when we should have been buying. So instead, Amazon was up like $1 and change. So I was just like, okay, made good money yesterday. It's up $1 and change. I didn't hit it out at the bottom. I just feel happy to have made money here, and I'm going to move on. And then PS, it was up, another $4 on top of it. But that's what happens when you're a trader. So you have to know whether or not you can handle the first 15 minutes, which is an art, but it is a little bit safer, which is what Sperling says, getting involved after about 30 minutes, because that's when the real money starts, getting involved, and it's a little bit easier to trust than just the fluctuations back and forth, which at times could provide some cash flow. I do make a lot of my money in the first 30 minutes, but the girth is really, thereafter.
I'm glad you mentioned that. We actually have a question about the trading the open market picker. Do you generally trade the open? Do you recommend this strategy for more experienced traders?
I do trade the open, and the reason being is because I do a lot of work off daily charts. Right. So with that said, typically if people, the rule is a stock goes out strong, that's a stock that you look to and you stay with and you take overnight. And if it goes out strong, basically, the next day if the futures are down, not stock centric because of the stock like today, or a few days, like I take Apple home a lot, long. And I'm always like, okay, if the futures are down because of something that Monty says or because of something or who knows why, I feel like I could always trade out of the position because it's going to go positive at some point. So what I do is I wait for Apple to gap down $1.50, futures go a little bit lower, and then all of a sudden you see Apple stop going down, you see a sign of relative strength, then you add to your position, and then it goes, and fills the gap, and then, you get out of what you added, then you stay with your position, and you just trade it out of it. Or if you go home flat, the first thing you do is you look at strong stocks that close strong in a down open. Same way, if a stock went out very weak and you have a big gap up, all of a sudden you look to the stocks that went out weak and say, you know what, it's only gapped up with the futures, it's not real. Let's wait for a divergence where the futures continue, stock stalls, you get shorted for a gap fill. So I like to use, strong stock chart pattern setups off the daily to then trade what the ARB is in the morning based on the futures, and that's how you generate cash flow around your positions. But again, just like today with Amazon, I went a little bit too fast because I was a little overexcited because I wanted to catch it, and then when the gyrations happened in the first 20 minutes, it just got me out of my size and had me sell it too early. So just know the time frame you're trading and whether or not you can handle it.
Okay. Our next question is from StockWitch.
StockWitch?
StockWitch.
Ooh.
Can you please explain a
No, Stockwatch.
StockWatch.
Well, which is someone meaning. I don't want to answer a question.
I've been in Vegas. Give me a break.
That was last week. You still recovering?
It was Monday.
Okay.
Can you please explain a pro gap?
Okay. That's a good question.
I don't even know what a pro gap is, so I'm glad.
You don't even know? Okay.
I don't think so.
There are a lot of gaps.
Okay.
A pro gap is a huge gap on an event that holds, that changes the direction of a stock. Okay. A pro gap usually happens, when you have earnings and it's something that people don't really think is going to happen, and you gap up huge, and then it consolidates and it doesn't fill the gap, and then it goes in the direction of the gap, and it goes in the direction for months or for weeks. A gap up on the open, if the futures are up 5 handles, that's not a pro gap, that's just a futures gap, and then you can play the divergence the way you want to. Like, I'll give you an example. A pro gap was in Western Digital. Western Digital gave you a pro gap right here. It was down in the dumps, it wasn't leading. Here there are 2 pro gaps in Western Digital actually. Look at this one. This pro gap right here was to the downside. It came back up, never filled this pro gap, so the direction was to the downside. Boom, 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 all the way lower, bottom end of the range, and all of a sudden here, I'm not sure if this was earnings, but some kind of good news, and it gapped up huge, trapped a lot of shorts, surprised a lot of people, never came in to even fill this gap. So this pro gap, meaning the pros are in control, of this on huge volume, that's going to dictate the direction. Same way this pro gap to the downside dictated the next 2 months. Then all of a sudden you buy tier 1, it goes over 40.75, and it continues. So this pro gap gave you 2 good entries and controlled direction. You see that a lot of times in earnings. Like Apple, has had a pro gap a few times. Like back here. Remember this gap? Huge gap on earnings, and it never attempted to fill it. And I remember saying, let's wait and see how much of this pro gap gets filled, and it didn't, so that dictated direction. Once it went above this 3-day range, it was a buy, and then here again it was a buy. But then sometimes it doesn't happen. Like this was in Apple, the pro gap to the downside, so you always want to see what kind of control it has. It came to the downside into support, meant nothing. That's why you always want to see if it gets filled. Once this got filled, you had to say, okay, I'm not bearish on Apple anymore because this downside gap, this pro gap had no control. People said, you know what, this is giving me on sale. This is giving me a way in. And remember we talked about on Apple, 580, 80 was the level to get in, and then boom, 3-day move. This was not a pro gap, this was just a regular gap. That's when I got involved in the swing trade. And then lo and behold, look where we are, trending higher. And at some point, I think relatively soon we're going to be testing this 644 in Apple, and it's been an unbelievable hold. So typically pro gaps, are gaps that control movement in the weeks/months to come. And pros protect their gaps. And if they can't protect their gap, then they're meaningless. And usually if they get filled in 3 to 5 days, then it doesn't control the direction.
All right, thanks, Scott.
Yeah.
I didn't know that was the name of it, so. Good to know.
Nice.
We're going to go out with that, though. I'm sorry there were so many questions today and we couldn't get to everything, but definitely tune in next week and we'll answer more.
Yes, and thanks for tuning in. And just remember, we try and give you objective, objective opinions. Is that like a little redundant?
It's okay.
It's an opinion. Anyway, what we do is we try and read the market action. We try and look at chart patterns, tight patterns that wind up expanding, giving you great entries, proper risk reward, and you can go with it. The risk parameters are different for everyone. Like you saw Sperling in here. Sperling, you go to the virtual trade floor, he has, I think, 18 to 19 longs on, where I have, I think, 6 or 7. So everyone handles different types of risk, and everyone has, different objectives of what they want out of the market. A lot of smart people out there have been shorting the market. A lot of people have been saying, you know what, I'm not getting involved because this is a hopium market, or this is a market based on stimulus, or it's based on central planning, or it's based on whatever it's based on. The market, you never know what it's looking at. It could be looking 6 to 9 months from now, which could be a much better environment. The spiders could be looking at what's transpired in the last, you go to the monthly chart, the last decade, right? Back here, the market was at 1552. That was in 2000. We're now in 2012. 12 years later, we've crossed this line so many different times, but a lot of people don't understand. Look here, look what the market did from right here. Okay, this was what, 96 up until I'm sorry, this wasn't 96. This was back in 95. The market base went from 400 and it doubled, right? So here's a double in the S&P 500 from here to here. Okay, then from here, just 800 to almost 1600. That's another double. So within a decade, the S&P 500 doubled twice. You don't think that this needs to be absorbed over time, trillions of dollars in whatever in market cap. So you go sideways here, and I know that being a macro investor, if you tried to pick your spots, hasn't worked. If you bought here and sold here, and bought here and sold here, which is what a lot of average investors did, unfortunately, over the course of the decade, you're not feeling great. But if you've cost averaged in monthly, 401k from even this point to now, and you're like in your 40s, you probably have an average cost in the S&P of around 1,200. Going in the middle of this thing, and once we absorb this entire range, which I do think we've almost been done with. That's why I said in the next 2-3 years, I think we take out the double top, get to 1,700, and then your macro investment plan, which is macro for a reason, meaning it takes a long time to work out, will finally be paying you. So at this point, look what happened here again. You go back to 1995 to where we were in 2000. That's 5 years, and the S&P went from 400 to 1,500. You don't think that it takes this long to digest it? So just put things in perspective. Back in the day, these .com stocks were trading at a PE of 150. Like IBM, case in point. I remember when IBM in 2000, the PE was huge, and then finally, the PE went down to whatever it is now, and then it's had a 4-year run. So sometimes you never really know why it's going on. Just look at the action and measure the price pattern and know your risk, and try not to have opinions, because too many opinions is what gets you in trouble. So that's why I think I do pretty well in the market, because I don't think I'm that smart. So I don't try and outsmart the market. I just try and trade the trend and look at the best acting stocks, use the different tactics that I've put in my tool chest over the course of the last 15 years of experience, and I tell it like it is. I'm a cocktail napkin technician, which you could probably be one too, because you love your cocktails.
Jeez, it's Vegas, cocktails. I swear I do more at work. My God.
Well, anyway, Art Cashin, who I try and emulate, I think he's unbelievable. Dan Zanger, awesome. They read the tape, they look at chart patterns, they don't try and be too fancy, and they go with what's moving the fastest, and they go with it, and if it's not, they get away from it, and they take accountability and say, I'll move on. We all make progress by making mistakes. Don't be scared to do so, and just be honest with yourself and take accountability. That's it. That was a big closing. I'm sorry. But we'll see you next week, next Thursday. Have a good night.
Night.